Hi, it's Carl Allen. Welcome to Module 8, Lesson number 4. You've almost made it. This is the final lesson before the last implementation exercise. So in this lesson, we'll go through the legal process. As with most of the due diligence, you won't be doing the legal work yourself. By now, you should have a contingent fee attorney or lawyer, somebody that you already knew, or a relationship that you've built. And I want to walk you through exactly what they'll be doing for you so that you know exactly what's going on. Again, your job is to be the quarterback of this deal, the coach of the team. The main document that you will sign to transfer the ownership of the business to you is called a sale and purchase agreement, an SPA. Or if you're just buying the assets of the business, it's called an asset purchase agreement, or APA. Then we'll walk through how deferred consideration contracts, the seller financing contracts, work as well as the shareholders agreement. We'll then cover one of the parts of the legal process that gets hotly discussed and negotiated as you zero in on the close. It's all about the warranties, the guarantees, the indemnities, and the covenants you'll need the seller to sign to give you the insurances and the assurances around the validity of the business. We'll also talk about employee considerations, including if the owner will be retained by the business in some way, as well as property or real estate considerations as well. And finally, we'll review what's involved in the external funding contracts necessary to secure any equity, asset-based financing, whatever that is. So let's start with the sales and purchase agreement, or SPA. It's the most important document you will sign to take control of a business, and it's a fairly comprehensive document. It's very similar to the document that you sign when you buy a house, when you transfer the ownership of the property from the seller to you as the new owner. If you've not bought a business before, it's pretty much an identical transaction, just with more clauses and terms and lots of other different things. Now, there are two ways that you can transfer the ownership of a business. The first one is an equity or a share-based transfer. This means you're buying the legal entity, whether it's an LLC or an S Corp in the US or a limited company in the UK or a PTY in Australia. You're actually buying the legal entity that's been trading, either the entity that was incorporated when the business was launched or the special purpose vehicle, or SPV, or Topco or Holding Co. that was set up somewhere along the way. And I'll walk you through those structures in greater detail shortly in this lesson. When you're doing an equity or a share-based transfer, you're taking over the shares for whatever percentage of the business you're acquiring. You'll remember from the deal structuring lessons that you do have the option to buy less than 100% if needs be. If the previous owner is retaining 10% or 20%, then obviously you won't be buying 100%. When you do an equity-based transfer, you're inheriting everything. So not only the shares in the business, but the assets, the liabilities, and also the goodwill. Goodwill is the difference you're paying between the price you're paying for the business and what it's actually worth on the balance sheet, which is the book, or sometimes called the net asset value. You're also inheriting all the employees, and more importantly, the reputation of that business. The other way of taking ownership of a business is just to buy the assets in an asset-based transfer. You'll sign an asset purchase agreement, or APA, which is kind of like an a la carte deal. You buy whatever assets you want and leave behind, or negotiate whatever you don't want. And it's important to consider the pros and cons of both methods. So there are 7 different factors that I want you to think about. They are: number 1, the level of due diligence required, depending on which method of used. Number 2, the speed of the transaction. Number 3, how selective you can be in terms of what you want and what you don't want. Number 4, the attribution of reputation and goodwill. Number 5, any credit issues for financing. Number 6, the inherent risk. And number 7, tax considerations. So for 1, the level of due diligence, you're clearly going to do a lot more for an equity-based deal because you're buying the entire business, warts and all. With an asset-based transaction, where you're picking and choosing what you want to acquire, the level of due diligence can be a lot lower because the level of due diligence needed is different between the two types of deals. It impacts how fast the deal takes to close. With an equity-based transaction, you're probably looking at 6 to 8 weeks. For an asset-based deal, it can be much, much faster. So when it comes to selectivity, with an equity-based deal, that's really not an option. But with an asset-based deal, you take what you want and you exclude from the deal what you don't want. That may make asset-based deals sound a lot better. But when you look at it in more detail, there are lots of positives around an equity-based transaction. The first is the reputation and goodwill of the business you're buying. When you're buying the whole legal entity, it's really important that you inherit the reputation of that business and the credit rating of that business. Remember, you're not necessarily borrowing the money to buy the business. You're leveraging the business that you're acquiring to borrow money. You're leveraging the balance sheet. You're leveraging the cash flows, and you're leveraging the credit of the business. Just like your credit's important, if you want to go and buy a car or even a cell phone, when you're buying a business, it's the business's credit that financials will look at. Because you're inheriting everything about the business in an equity-based deal, there's inherently going to be a little bit more risk. You're taking the responsibility for whatever's gone on in the past, whether it's been disclosed or not disclosed. However, your lawyer has lots of different methods at their disposal to limit that risk. We get into some of them shortly. Next, let's look at the ways to legally structure these deals. So clearly, you're going to have an existing company already. When you're doing your first bolt-on acquisition, you want to set up a top co or a holding co. Now, your top co will allow you to keep your existing company and the target company separate. Why is that important? Well, if you buy the target company and then something bad happens to it, it's not layered in and baked into your existing business. You can just liquidate the target company and then just carry on as you were before. The other option is to have the top co, but acquire the target company as a subsidiary of your existing company. Again, it's a separate legal entity. So if anything goes wrong, just eliminate that from your group structure. With an asset-based deal, you need to put the assets into a legal entity, just like putting furniture into a house. Your lawyer will set you up with a new special purpose vehicle, or SPV for short, to hive all of the assets and liabilities that you're taking. So as with the equity-based structure, you'd have your top co or your holding co to house your existing company. Then you create the SPV under the holding co to control the assets you're acquiring. Next, let's look at the legal process as it pertains to seller financing. Seller financing can also be called loan notes, deferred consideration, or deferred payments, especially in Europe. It can also be called vendor financing in Australia. Earnouts, the seller financing payments that are contingent on meeting certain KPIs, can also be called stage payments, drip payments, or leased to buy. If the seller's prepared to effectively loan you the money, more often than not, they'll earn less than 1% interest, especially in the current times. So they might want a 5% or even a 10% interest coupon, since you're paying interest on that money over time, just like you would if it was a bank loan. Since earnouts are contingent on performance, the seller financing can change depending on how well the business performs. In some cases, the seller may want security over those payments by releasing the equity to you only after those payments are made. The other issue to consider is a shareholder agreement. Now, shareholder agreements are dead simple, and they're not required if you're buying 100% of the business. A shareholder agreement, also known as an operating agreement or a members agreement, specifies the shareholders' rights and the rules for how the business is to be run by the partners or shareholders. And you may be partnering with someone on the deal that knows the industry better than you. You could have multiple equity investors. You could have a seller that's retaining some equity as a partner in the business. Depending on how many and what type of partners you have, the agreements can get somewhat complicated. Your lawyer will need to draw up a shareholders agreement to dictate how the business is actually going to be run by everyone involved. Next, let's get into security, your security. This is really important. We've talked before about seller security, those ratchets on equity like clawbacks, dripping equity, etc. But we also need to talk about your security. What do you get as an insurance policy for buying the business? There are 4 elements to this: warranties, guarantees, indemnities, and covenants. I'm going to go through them all one by one. Now, a warranty is a promise or assurance that something specific in the business is as represented. Warranties always have a time limit. So a good example of a warranty is on the accounts. So sellers have to warrant the validity and accuracy of their accounts, that they've been prepared and filed as a true and accurate representation of the business's performance. If a warranty on the accounts is breached, the seller will receive financial penalties. If the accounts filed are wrong and they've been warranted, and you come to find out that the revenues weren't as high as reported and the margins weren't as high and you've actually overpaid for the business, if something has been missed, having a warranty on the accounts is like an extra security blanket. For example, your lawyer could write into the sale and purchase agreement that future seller financing payments will be offset against any breaches of warranty. Or if it's that serious a breach, then you have the right to sue the seller. Now, a guarantee is slightly different. A guarantee is a formal assurance that something will happen or has been fulfilled. Guarantees are not typically time bound. A good example is if the seller has an overdraft from the bank and you've agreed as part of the deal that the seller must repay that debt from his or her closing payment. The seller will sign a guarantee committing to repaying that money. If they don't repay it, then it will be determined as a guarantee breach and they'll have financial penalties assigned, or you can sue them. An indemnity is a security or a protection against financial loss or burden. A good example of an indemnity could be product liability, where the seller protects you as the buyer from any product liability claims for a number of years on products already sold. I talked a bit about this during the program about a marine safety deal I was involved in, where the whole product liability situation almost railroaded the deal. It's a requirement now in most jurisdictions and most industries for businesses to carry product liability insurance. When you've acquired the business, even if you've got your own policy, that existing insurance should cover everything sold in the previous years. But if for whatever reason something falls through the cracks, an indemnity will mean that you can pass the liability back to the seller either through direct litigation or by reducing those deferred consideration or seller financing payments. And then finally, you've got covenants. A covenant is a solemn promise to either do or not do something. An example of a restricted covenant would be to make the seller promise you not to restart the business you just bought from them in the next town, kind of like a non-compete agreement. You'll see restrictive covenants a lot in employment. It's the same when it comes to sellers leaving businesses. If an owner sells their business and then 2 weeks later sets up shop doing the exact same thing, that's a breach of that restrictive covenant with financial penalties for the seller. You can either sue them or just cancel the deferred payments if that is indeed written into your legal contract. Finally, let's look at some of the ancillary legal topics that your lawyer is going to figure out for you. This includes employee consideration, retaining the owner, property considerations, and contracts from anyone financing your deal. With employees, if you're buying the shares of the business, then clearly all the employees are coming with you. However, in most countries, even if you're only buying the assets, you are by law required to transfer some or all of the employees that are inherently linked to those assets. For example, in the UK, there is a regulation called TUPE, T-U-P-E, which stands for Transfer of Undertakings Protection of Employment. During any transfer of ownership, it ensures employees' jobs are protected before, during, and after the transfer. It's a pretty complicated situation. Clearly, your lawyer will figure all of that stuff out for you. In the US, there's something similar called the Employee Rights Law. Again, your lawyer will advise you on this, but essentially, when you inherit employees, either through an asset-based deal or through an equity-based deal, by law, you have to honor the terms and the conditions already in place. You can't halve someone's base salary. You can't halve the number of days of vacation that they get. You can't halve their benefits. If you do want to drastically change them, you have to make some kind of financial gesture that's got to be agreed and negotiated. Again, your lawyer will sort all that out for you. Next, if the seller's staying in the business, not as a shareholder this time, but maybe they just want to stay and help you, they might want to run the business for you, they might want to work part-time, they might want to do an extended handover period. In any of these cases, they'll need to have a consultancy agreement if you don't want them to be an employee in the business. And with a consultancy deal, you can agree to have a daily fee or a monthly retainer, whatever you prefer. And like any other contract, you'll specify what they're doing, how many hours that they're working, what they'll get, what they don't get, all of those different things. If they're employed in purely a business development role, then you can also link bonuses to that consultancy agreement based on commissions or increased performance and things like that. Your lawyer will sort all of those arrangements out. Next, if you're buying a business with real estate involved, you've got the option to take or not take that real estate. If the deal warrants it, you can inherit the building as part of the deal. Your lawyer will likely advise you to carve the property out and stick it into a separate property company. That means if anything bad was to happen to the business, you can keep the property. This way, banks or lenders couldn't come after the assets and you could still lease or sell that property to somebody else. If you're not taking the real estate as part of the deal, you'll need a contract to rent it moving forward. You might wait and have an option to buy that property at a future date, or you might do something called a sale and lease back. You might take the property and sell it to somebody else and then rent the real estate from that property and invest it. There's a whole bunch of different things that you can do. Finally, let's talk about funding contracts. When you're raising financing secured against a business's cash flows, the assets, whether it's equity, it doesn't matter. Your lawyer will negotiate that will include the terms and conditions of the funding. In other words, what the interest payments are, what the capital repayments are, how interest could change, if there are revolving facilities from accounts receivables or inventory financing. Those are typically just lines of credit, so you'll only service the interest on that debt. You won't have to make the capital repayments because you're continuing to use those revolving facilities as you continue to grow and trade the business. Funding contracts will also include what the investor wants from you in terms of reporting and covenants. And remember, covenants are financial rules that you need to stick to when you're taking someone else's money. With the reporting, if you've got an angel investor or a private equity firm or even a crowdfunding platform, that investor is probably going to want to join your board. They're going to want an active role in overseeing the strategic vision and the custodianship of the business. And for that, you'll have to create packages of key management information for every board meeting. If you're taking money from an asset-based lender or the SBA, they're going to have vastly different reporting covenants. They're not going to want to join your board or come to board meetings, but they're still going to want to see data from you on a regular basis, normally monthly. They're going to want simple monthly reports. They're going to want to see your age receivables, your age payables. They're going to want monthly management accounts, revenues, profits. They're going to want to see updated rolling forecasts, KPIs as well. So here's where covenants come in. The covenants could be around sales and growth performance. The covenants could be around profits and margins, around cash flows, or around all of these things. And the funder will tell you what those covenants are, the rules, and that's the info or the data you need to supply to them on a monthly basis. If you breach these covenants, if you breach these rules, then a couple of things can happen. If it's a minor breach, the lender will just increase the fees and the interest. So if you're paying 5% on the loan and you breach the covenants, the profit covenants, the lender could increase your interest payment from say 5% up to 8% and maybe charge you a $1,000 monthly fee or something like that. If you consistently breach covenants and massively missed forecasted targets, they could do more serious things. They could pull the financing completely or give you 90 days to go and find an alternative funder. To give you an example, let's assume that you borrowed money at a 5% interest rate. The covenant requires the profit or the free cash flow has to be at least 2 to 1, the amount of interest that's being paid on a monthly basis. So if the free cash flow is $500,000, the interest payments were $200,000, then the ratio is 2.5. So that's okay. If the free cash flow is only $300,000 and the interest is $200,000, then the ratio is only 1.5, a breach of the covenant. You're still okay. You're still making money. You've still got cover. But the lender might say, well, no, you breached the covenant. This is where the lenders really make money. They might want an extra couple of points of interest, or they might increase their fees. If your cash flow plummets to say only $100,000 and your interest payments were $200,000, so the ratio's 0.5, that would constitute a more serious breach where the funder might say, well, there's cash in the business to cover it, but if this carries on for 2, 3, 4 months, then there could be special measures imposed. So that's it. That's everything in terms of legals. Again, you're not doing this work. These are all the things that your lawyer is going to be doing for you. But when they're talking to you about all this stuff and negotiating on your behalf and reporting back all of this to you, I want you to be fully aware of what's going on so you can quarterback the deal and be the coach of the team. So that's it, my friends. The final lesson is done. We'll wrap up Module 8 and this program with the implementation lesson. So I will see you guys there. Until then, bye for now.